flipping a house and the possible tax consequences. Buying a house, renovating it quickly, and then selling it again isn't as seamless as HGTV's Flip or Flop and Fixer Upper make it look. And it's important that you prepare for the never televised side of property investing, and that's what we all fear: taxes. So flipping houses can be an exciting venture without a doubt, and one that, if done correctly, can bring you the kind of return on investment that you've been seeking. But buying a house, renovating it quickly, and then selling it isn't as seamless as the TV shows make it look, which brings me to an always dreaded subject, which is taxes. Taxes are why you hire accountants, but studying up before on a flip and how it can save you surprises and a lot of money at a later time. So here's a few guidelines. The most important consideration in flipping is how long you're going to hold on to the property. If you retain the property for more than a year, federal law rewards you by treating any profit from the sale as a long-term capital gain. That means that the tax rate on your profit is much lower, maximizing out at around 20% for investors, even at the highest income tax bracket. Now, for those that are in lower brackets, the rate could be as low as even 0%. But if you flip in less than a year, tax rates are not in your favor. Money that you make by buying and then selling that same property in less than a year is considered a short-term capital gain and is taxed at ordinary income tax rates, which are much higher, and you can max out around 39% of your profit. Yet the acquisition can get far more complicated than that, especially the more frequently you flip. What you should be mindful of is whether or not what you are doing could be considered purely an investment. Is flipping something that you do in addition to your daily job? If the government can make that case that it's more than just an investment, they'll try to recategorize a transaction as a trade or business, and these profits are handled differently. For someone looking at flipping occasionally, it's unlikely that the Internal Revenue Service would consider that activity as a business and will treat it like any other investment, such as stocks and bonds. There's no magic number for at what point it transitions into a business, but the more houses you flip, the greater chance that the government will call it a trade or business. So the result, even more taxes. Not only are flippers' profits taxed as ordinary income, but they also can be subject to self-employment tax, which can cost a lot of that profit that you would otherwise earn. Now, there are a lot of ways to be creative. According to the federal law, a homeowner can qualify for a federal tax exclusion on a sales profit if the home is considered a primary residence. The IRS would need proof of the residence, such as a car registration or utility bills. And a homeowner must have lived in the property for 2 out of 5 years. So when it comes time to sell, the law allows a single homeowner to exclude up to $250,000 of the profit for federal taxation. If married, the exclusion doubles to $500,000. So you could buy properties, move in, take your time over multiple years to rehab those properties before selling, living amongst some of the construction noise and the inconvenience, but allowing the value to appreciate. Although as investors should understand the tax implications, a decision to flip should never be made on taxes alone. If renovations are taking longer, at least there might be a tax advantage, but sometimes it's important for you to move the asset so that you can purchase another property. Sometimes the opportunity of that might be a greater than the tax consequences of doing the sale. So my advice is understand your options so you can make a sound financial decision. And that's a Money Chat for today. Coming up next on the Money Hour, protect your home during vacation. Jeff Prescott with RE/MAX Metro Realty right here at 1150 AM KKNW after this short break.